Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Yeah, first one, I just want to have a question for you, Randy, because as you know, I give a lot of presentations, mostly, well, I shouldn't say mostly live. I do both, but when I'm doing a presentation like this, I always get a couple folks that say, why don't I just always sell out of the money options for a very little amount of money because the likelihood of success is much higher. I think you touched on it, but do you mind just reiterating why, just because you're selling out of the money options doesn't mean it's any better than selling, an at-the-money option or an at-the-money spread? Do you mind just going through that risk-reward again?
Yeah, I sure will. Exactly. It's a good point. And it's one of those things where selling naked options is a strategy that a lot of people use. And statistically, if you looked at something like, say, the S&P 500 index, what you would find is over the course of really a lot of years, 30, 40, 50 years, the amount of time that the S&P 500 moves more than 5% over a month is like 10%. It's only like 10% of the time. It's a very small percentage. So you might go away. If I sold options that were naked, that were out of the money more than 5%, I would make money 90% of the time. You're right, you will. But guess what? In November of last year, you'd have lost everything. In February of this year, you would have lost everything. You would have lost so much, you would have wiped out your last 50 or 100 trades. That kind of risk isn't worth it. You've heard the term black swan. Nassim Nicholas Taleb wrote a book about it recently. You can't expect the unexpected. It's not possible. The fact is, you do the spread so that you can account for that unexpected. Here's the way I like to look at it. It's just like driving your car without insurance. If I owned a $100,000 Porsche Carrera, I would not drive to work every day without insurance. And guess what? I haven't had an accident in my car for, 10 years probably. I have not had an accident for 10 years. But that doesn't mean I won't have an accident tomorrow. I might have one on my way home today. I can't expect that's going to happen. The insurance that you buy when you buy the cheap, out-of-the-money leg on a spread is so cheap relative to the potential profit that you give up, it's always a good idea to do it. It really, really is. It doesn't matter if you make money 90% of the time. If the 10% of the time that you lose money, you lose enough to wipe out the 90% of the time that you've made money. And that can happen. Believe me, I've seen it happen on a lot of people. That's the reason why I always advocate credit spreads, so that you don't have that problem.
Wow, Randy, that's a great analogy. And if you think about it, all the attendees, if you think about this, and if you were to own this $100,000 Carrera, what you would probably do if you didn't buy insurance is almost never drive it, except if it was 74 degrees and you're going to go 1 mile from your house. You never would drive it, right?
That's right. It's one of those things that you when you buy insurance for your car, it's one of those things that you pay money for and you really hope you never need it, but you got to have it there. Just like medical insurance. I haven't had a surgery since I was 10 years old. That's 35 years. But guess what? I may end up in the hospital next week. I don't know. And I've had medical insurance for the last 35 years I didn't even need. But I got to have it because you never know when that bad thing's going to happen. Guess what? If I have a heart attack tomorrow and I didn't have medical insurance, my whole family, I could be bankrupt. I can't take that risk. And the truth is, when you trade nakeds, that's the kind of game you're playing. You're the lottery company. You're selling tickets to somebody really cheap, and you're collecting those dollar premiums, and you're hoping nobody picks that winning number. But guess what? If somebody does, you're sunk, and that's what happens. So you can't do that. It's not worth the risk. There's a question here from Lee that says, show the last chart. Let me jump back a couple of plays here, and I'll show it to you. So on this, here's the last example that I did. You can see that the index was at 134.93 when I set this trade up, and my maximum profit would occur if both these options expire worthless, which would be at below 134. Okay, so I need about a 93-cent move down in order to hit my max profit. but my break even is 135.70, so I don't even need any move in order to make some money on this one. All I have to do is have it just stay right where it's at. This one turned out to be a beautiful trade because, like I said, it went all the way down to 127 and change over the next 2 weeks. It just crashed and burned, and this trade would have made $1,700. It would have been a great trade.
Randy, you see that question from Joel? Do you mind commenting?
I'm not seeing it. No, where is it here?
Okay. I'm sorry. That's just to me. He wants to know if you can write a contingency order to buy back the option if it hits the strike price. Do you have that at Schwab, Randy?
You can do a contingency order on a single position, but you can't do it on a spread. In other words, I could put out a contingency on the two legs separately that says, hey, when this leg hits this price, I want to close it out, and when this leg hits this price. But we don't have contingencies that are sophisticated enough to work off of a net credit or a net debit price on a package or a spread trade. So that's it's a great idea, and it's something that we've had requests for, but it's in the works. It's not been released yet. I'm not sure a lot of people have that kind of capability. There may be some people out there that do. Here's what I would do. I would set what I call an alert tool, and we do have this. The alert tool, which is one that will pop a message up on your screen or set off a little ding, ding, ding alarm on your computer that will tell you when a certain price is hit, and then you can go in and enter your order at that time if you want to do that. That's the best way to do it. We can't have it where it actually sends the order, but we can put up an alert that will give you that'll get your attention when it happens.
Thanks. Rodney has a question. I think this is back to the question that I pointed to you, and he says, if you had done the out of the money on the two losers, would you have made a profit? Of course, that would have depended on which strike prices you selected. But I think what his point that he's missing, I would guess, is that your reward would have been so small. Who knows if it's worth the risk, right?
Yeah, that's something you have to always think about on a credit spread. Okay, since when you do a credit spread, you're trying to bring in the credit up front, and your goal is to keep as much of that credit as possible. Hopefully, all of it. You can do spreads where the options are way out of the money, but if I'm going to do a spread where an option's way out of the money and I'm only going to bring in, say, $50, if it's a 5-point credit spread, I've got $450 at risk if I'm wrong, and I can only make $50 if I'm right. There's a point where the risk and reward trade-off is probably not worth it. Now, granted, chances of making that $50 might be as high as 70 or even 80%, but I'm not sure that I'm willing to take the risk even with an 80% odds in my favor of making $50 if I got to put $450 at risk. And that's on a 1-by-1. If I did a 10-by-10, we're talking about making $500 and putting $4,500 at risk. Now, I'm probably only going to be wrong 10% of the time, but I'm not sure that I want to put $4,500 at risk because you know what happens? That 10% of the time comes up that trade. That's how it works out. So you always have to weigh sort of that, how much am I going to make on this versus is it worth the trouble? You know, is it worth the risk? I typically look for something where I'm going to make about a third as much as I could lose. A lot of times people sort of evaluate a spread and they say, well, if my maximum gain is smaller than my maximum loss, then why would I want to do that? Why would I want to put $2,000 at risk to only make $1,000? Well, what you have to think about is that it's not just the max gain to max loss ratio that's important. It's the probability of a profit versus the probability of a loss. And the truth is, if you flip over the max gain to max loss ratio, that gives you your probability of profit. So in other words, if you put up a spread that has $1,000 max gain and a $2,000 max loss, that means that you're risking twice as much. But you know what? That means your probability of profit is twice as great. The smaller the amount of the profit, the higher the probability is that you'll actually make that profit. So it makes sense that you want to have a small max gain and a large max loss because you want the probability to be high. But again, there's a point where it's not worth it for that $50. For a couple hundred, yeah, it might be worth it. For $50, it's probably not worth it taking that kind of risk.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.